Speaking of Alternatives with Keshav Rajagopalan, Head of Strategic Capital Group at PGIM. Within private credit investing, the secondary market is a fast-growing subsector, similar to what has been further developed on the private equity side, offering expanded opportunities and greater diversification. Keshav explores the world of private credit secondary investing with Alex Stuart, Head of Private Credit Secondaries at PGIM.
Welcome to Speaking of Alternatives, the podcast where we dig into the many layers of the alternatives landscape. Today, I'm really excited about the conversation with Alex Stuart, my colleague at PGIM, who heads up our Private Credit Secondaries platform. Welcome, Alex. As we start out all of these conversations, let's find a little bit more about you. What has brought you into the investments industry? What's kept you at PGIM? And what keeps you excited about what you're doing now in our Private Credit Secondaries platform?
I have been at PGIM for about 19 years now. Really, the entirety of my professional career has been at PGIM. I actually began it here in New York City and then worked my way west across the country, settled in Minneapolis. But I kind of stumbled my way into private credit, to be honest. You think back to our college classes, fixed income was something you kind of quickly glossed over in your textbooks. It was all about consulting and investment banking and private equity.
I wanted consulting, so yes.
Yeah, not trying to offend anybody, but I'm staring at our mutual gray hairs and thinking we kind of came out at the same time. And the opportunity with what was the legacy PGIM private credit business was a very interesting one back then. And it evolved into something, I think, a lot more than I expected it would. It's very dynamic, unique on the private side. I think about the access to information that you get, the deepness of the conversations you can have, your ability to understand different assets and different companies. You learn there's a lot of business models out there, and there's a lot of ways to make money in this world. Looking ahead, it's such a dynamic time to be in private credit. There's rapid positive change. It's a pretty exciting place to be.
While the private credit secondary market might seem novel to some investors, a helpful way to think about it is as an effective way to defray risk through extensive diversification and access to a broader array of investments.
So taking a step back before we dive in a little deeper, private credit secondaries, I wouldn't say it's brand new, but it's the new kid on the block, especially in the field of private credit. You hear about private equity secondaries, that's been around for much longer. So tell me, what is private credit secondaries?
By definition, it is a derivative of another asset class. So you have to understand the primary before you can get into the secondary. But by and large, you are buying LP equity interest in seasoned credit funds. This is not direct loan origination. This is not NAV finance. This is not fund finance. This is working with LPs that are in debt funds or GPs that run them, working through liquidity solutions or some other issue they're working through in their fund. The vast majority of volume that exists in the market is by and large direct lending volume. And there's going to be other pockets of different kinds of funds in the mezz world or unitranche or second lien or distress. But by and large, this market is a direct lending derivative. We're buying and stepping into an existing direct lending fund.
And then where does it fit in a portfolio? So alternative, credit, where would one bucket it?
The way that we talk about it and we hear most of our market players talk about it is more on the credit side, because effectively your underlying risk is really direct lending from those same positive elements of a very dependable current cash yield, upper single digit range from a pretty diverse portfolio of underlying assets, much like you're going to have in direct lending, where in a DL fund, you might have one GP and maybe 60, 70, 80 underlying loans, a handful of sectors, maybe a few geographies, which is all very helpful for potential investors. When you go over into credit secondaries, you kind of turbocharge those things and you get into 10 or 15 different GPs, multiple vintages, 500, 800, 1,000 plus loans. So the benefits of that diverse portfolio really resonate more kind of in that credit bucket. We don't really view it as replacing and having a new spot for potential investors. You really got to think about it as something that complements an existing credit exposure. So we expect this to evolve in the same way that it has evolved on the private equity secondary side, where if you are active in PE secondaries, you might have 80% of your equity bucket being primary and then save 20% for secondaries. We're at very early stages in credit, as you mentioned, but I think you're going to expect to see a similar dynamic of folks that want to maintain that primary DL or mezz exposure and then have a secondary exposure through our vehicles or a market vehicle.
As you mentioned, complementary gives you diversification benefits, but it should look and feel like the underlying instrument here, which is in this way, direct lending mezz, but a form of private credit. So private equity secondaries has been around for a while because the private equity industry has been around for a while. Private credit, while isn't brand new, certainly the growth of it is, in terms of the turbocharged growth, is relatively recent if you kind of think about market terms. Is that why private credit secondaries have now sprung up? Given it is a derivative, you need the underlying market to have the depth and breadth for this then to make sense?
100%. Anytime that you get a market in private credit, where obviously the equity market is 10, 11, 12 trillion, very natural to have a long developed secondary market in that space going back 15 plus years. With private credit now hitting, pick any public data point for this market, $1.7 trillion, 2 trillion, 2.5, whatever it is, you get a market that big, it's very natural to need to have a secondary market behind the scenes where folks can find liquidity and realign their portfolios as they see fit. So you've got the scale and the growth of private credit driving the need for a secondary market has been a big part of it. I think also you finally got, and we'll get into this, just the right cost of capital for players on the buy side in this space, which private credit's a pretty good asset for an investor to own for a number of reasons and is usually marked at a pretty attractive place pretty consistently. If you are a private equity buyer stepping into that market as they were 5 or 6 years ago, chasing PE returns, it's going to be very difficult to get an LP or a GP to transact with you when you want those kind of prices for the risk you're getting in private credit. But as you've seen these dedicated vehicles get raised the last handful of years in the credit secondaries market, pricing comes down and matches where the real risk is. It makes a lot more sense for LPs and GPs to be doing things and really supporting this growth moving forward.
Private credit secondary investing offers liquidity benefits to the partnerships that raise funds on the secondary market, as well as participants who seek competitive returns and more extensive exposure to the private credit market.
You hit on a little bit of this. Why now? It seems there's the growth in private credit that has certainly spurred the need for a secondary market. But if I'm an investor, what's attractive about an entry point now is we're talking about to our clients this to complement their existing private credit portfolio.
There's two main ones that jump out. The one that we talk through most often, and you're going to hear other market players talk about it, is just the risk return dynamic that you can get in credit secondaries, which is really made available by the fact that as a buyer in this market, because you are providing liquidity back to LPs, your compensation is you are able to purchase these portfolios at a discount to their prevailing NAV. So from a return standpoint, you take that direct lending fund, which let's just call it, 7, 8, 9% on a net basis, because you're buying it at some effective discount, you're going to get a level that's above a primary DEL format that we, in most instances, you're going to see somewhere in the low teens type range. What's also beneficial is the discount and its ability to help you manage the risk of loss on the backside too, because you're implicitly stepping into a performing DL portfolio or a credit portfolio more broadly. And that discount is going to give you some higher degree of a loss absorption you otherwise would have if you're a primary direct lending investor. So you take those two together, on a higher upfront return, lower expected losses on the backside, creates a very compelling product, we think, for folks coming into this market. And the second biggest one we got to earlier is just the ability to do this highly, rapidly, broad, diverse platform where even if you're already in DL and you have some allocation to really push that harder across GPs and vintages and sectors and geographies, or if you are brand new to direct lending and you want to build that out, if you're going to do it on your own, it's going to take you a handful of years to go out and select individual GPs and new funds. If you did it in a secondaries market, you get that instantly. That's just incredibly appealing, we think, to a lot of folks in this space today.
I like to unpack a headline each episode, and this headline's the flip side of what you were just saying, that while there could be an attractive entry point now, PitchBook has noted that discounts are actually fading for private credit secondaries because the market is growing. What are the implications of that? You have to always have an attractive entry point and this market kind of ebbs and flows versus being all weather? Or is this just a little bit of a glitch in the system and something that'll work through being a little bit more episodic? But what are the implications of if discounts are fading, some of the risk-adjusted return benefits you were just talking about?
This question comes up a lot. Every time a new continuation vehicle gets closed or announced, somebody re-releases this article about discounts compressing. It's the same thing every time. And it's factually correct, but there's reasons why that's happening that make a lot of sense, particularly from a buy-side perspective. But as we can get into underneath the surface where the real game is decided on what the pricing actually is. If you go back 5 or 6 years ago when credit secondaries kind of first started getting going, you have folks with a PE cost of capital coming in this market, and that results in very wide discounts for performing portfolios, which did not make any sense, but there wasn't much volume out there beyond that. There wasn't much capital, so that was the price. It was upper 70s, low 80s.
Just because of cost of capital. They were just saying, hey, that's what I need.
Purely a cost of capital issue, right? As capital has been formed in this market that's much more appropriately sized and proportioned to the risk, you've seen discounts come back up to a very reasonable, rational place. I think the question is, hey, we've seen it in the news that they continue to go up. People say it's pricing at par or above par. What does that mean? And where do they go from here? I think the biggest thing to clear up is it's not at par. Par is NAV in this market. And NAV for even some of the best performing direct lending funds is going to be a slight discount across the board. So if you're stepping in even at NAV for a good performing portfolio, you're going to ride that back up to par through exit, and you're going to get some incremental return on that alone. However, the nominal discount, the price relative to NAV, is easily the most important thing for a seller. It's the most important thing for the investment bank running the process, and that's all that you hear about get announced publicly. Behind the scenes, as a buyer, you have several other levers that you can pull to get you to your required rate of return. The one that's most commonly used, it's very intuitive, is the concept of effectively accrued interest. There's this post-reference date concept in credit secondaries where if I'm buying as of, let's say, 3/31 coming up here in a few months, you are picking a reference date, a valuation date for that portfolio that is often 3 and really 6 months before your closing date. It sets your most recent NAV mark date. So you say, okay, I will buy it from you as of that reference date, 9/30/25 at NAV. However, all of the cash flows that come from October 1st to 3/31 of next year before we fund and close, they accrete to me.
It's just a cushion kind of embedded.
It's also very intuitive because I'm taking the risk of further changes up or down, which in a credit portfolio, more of your risk is going to be down just by nature. I'm taking that risk for 6 months. Part of my compensation is I get that 6 months of cash coming off the portfolio. It's the same thing on the equity secondary side. The nuance here, though, is because you have this dependable, ideally dependable and consistent cash flow coming off a DL portfolio, 6 months of interest is pretty meaningful for a buyer. So you can imagine a portfolio priced at S plus, let's say 600. 6 months of that might add 3 or 4 points to your effective discount, right? So you're saying I'm buying at 100. No, I'm buying it more like 95, 96. That's very common. That's probably the biggest determinant. Number 2 is this concept of payment deferrals. In this example, I will buy it on paper at 3/31, but I will give you the cash on 6/30 or 9/30 of this year. So I own it. I haven't paid you for it yet, but I get all the benefit of those cash flows, which will continue to work down my purchase price. It's cash I otherwise would have gotten, but it's a nice lift to your IRR. Sellers should care to an extent, but again, it's not cash they would have otherwise gotten. It's just a deferral, but you can do that to try to bridge a gap with the seller. You do see leverage used quite a bit. Leverage in credit secondaries is incredibly efficient because the portfolio is fully funded day one. You don't really have that ramp that you're going to have in a DL fund where you might need to put on a few more turns of leverage to get that return benefit. In secondaries, you can do a turn or less of leverage at a pretty cost-effective rate and get a very nice boost in your return profile. And then for stuff that gets a little bit more challenged, where you got to bridge a larger pricing gap, you get at things like earnouts, which you see here and there as a way to make it work. But you are starting with, as a buyer, what you think is the right nominal discount for the portfolio. And you're going to get pushback from the LP. You see how far you can get, and then you figure out all these other levers kind of behind the scenes. But none of these get reported publicly. They're all the secret sauce, so to speak.
It's the structuring component.
It's a huge part of the transactions where if you can do it correctly, that allows you to buy these portfolios at very nice, effective discounts and maintain that low teens type return profile.
Let's pivot a little bit. Talk to me about tailwinds you're seeing as we're in the marketplace and looking at possible transactions, and then also talking to investors. What's exciting you about the opportunity set today?
Well, our inventory in credit secondaries is just primary private credit. And the more that grows, the better for us. So when you see forecasts of $4 trillion by 2030, that obviously gets us very excited about the opportunities that flow into our market in the secondary space. I think also as you see more and more LPs using it directly and more GPs gaining comfort with the structure and the solutions and all the benefits to them to access the market, you see that knowledge improve. That's really going to help get our AUM transact level up and a little bit closer to PE secondary. So you go back the last 8, 9, 10 years in the PE secondaries market, on average, 2 to 3% of AUM transacts kind of year in and year out in the secondaries market. Within private credit, we're probably under a point right now. But again, as both LPs and GPs gain comfort and get access to it, you're going to see that rise along with the rising primary AUM. So that gets us pretty excited. Also, if you understand what's happened in the private equity secondaries market, where it evolved from the early days, the simplest form of transaction, a single asset CV, high performing asset owned by a brand name, large cap PE sponsor. And then today, it's brought into a variety of transaction structures, mid-market, lower mid-market GPs, multi-asset CVs, the whole host of transactions. We're very much in the early stages of credit secondaries where by and large, most of the flow is performing direct lending, and it's mostly large cap performing direct lending. And as you know, there's thousands of good quality mid-market, lower middle market GPs in the private credit space that you're going to see come to market the next handful of years. So you got that element. And then the transaction structure, all the benefits that you can achieve as a GP, we're very much in this very simple CV type world. But the opportunities,
as the market matures,
as it matures and folks get more creative, it's not just solving a duration issue. There's distribution, fundraising issues.
We've talked about it with insurance companies and how you can structure it in capital efficient formats. And
yeah, I think it's going to evolve immensely, which is very exciting for us. So I think this momentum, sure, it might not sustain itself at 50% growth per year, but the market's growing in a very quick manner.
Flip side, what are some challenges, especially the emergence of a new kind of sub-asset class?
Yeah, it's very topical. The continued growth of evergreen structures, whether it's retail funds or even institutional funds or interval funds, where documenting the offering of liquidity. This market is not all about liquidity, but it is a meaningful part of why people do things. And if they're getting enough liquidity in the other vehicles and we move out of closed-end vehicles to more open-end evergreen structures, does that diminish the need for secondary solutions? I could make a case of evergreens or BDCs, all these other, SMAs, all these other structures in themselves also create very unique secondary solutions more broadly. But if you see the market move wholesale in that direction, there's a bigger concern of, is there going to be less demand for our products because they're getting liquidity elsewhere? I don't think that's the case, but it's one to think about just longer term. The other big one is, back to your headline, I think there's a little bit of misconception about CVs right now in terms of the benefits to LPs that folks just need to be educated on. And I worry a bit about them pulling back because they're having an immediate adverse reaction to a CV from a GP partner because they just heard the news about it. And then when you're dealing with a direct lending CV and you have 150 loans held across multiple vehicles coming in a new one, it's complex. It's just a lot of moving parts, moving pieces, election processes, LPAC approvals. From an administrative standpoint, it's an ultimate home run for the GP at the end of the day. But to go through that 6-month journey, there's pitfalls left and right that can kill something that you got to be mindful of. As we've seen a handful of really good investment banks step into this market and be a good advisor for these GPs and LPs, that's really helped to push things on a bit further. But these are big, complex processes.
In the face of challenges in the burgeoning private credit secondary market, it can be quite helpful to have the resources and backing of a larger organization.
All noted. So we have some questions from the floor. We gather what's on the mind of clients via our distribution teams. Is this too good to be true? It's new in the industry. Is it just kind of a, hey, first market mover advantage and shoe will drop at some point? How do we think about let this stuff play out a little bit and hope that people aren't holding a bag at the end of the day? What's the counter to that?
Yeah, and that's often the first question that we get from investors is, hold on a second. 10, 13% for performing deal. I'm buying at a discount. I get this loss advantage. I don't believe you. And you hear the headlines and they get all thrown off. I think one of the major concerns people have of these have to be old, storied, underperforming loan. This is the end of the fund. They did 80 deals. There's 15 left. This is the junk and they'll sell it at any price possible.
Yeah, the adverse selection.
And that's how you get 13%. Those deals do exist, but they price in a very different manner in a way that should reflect the risk in those longer tenured, tougher portfolios. But by and large, most of the portfolios that we see come to market are going to be in the 1.5, 3.5, 4 type duration range. These are relatively still young, fresh, performing loan portfolios. You might occasionally see the 7.5 year one for very obvious, like end of fund life reasons, but they're going to price quite differently. I think what might surprise folks that actually exists is if you take a step back and just think about the life cycle of a DL fund. Everyone thinks you're making 3 to 5 year loans. It's a 3 to 5 year life cycle. It's not, right? You've got 1 to 2 years of fundraising. You've got a 4 to 5 year investment period with full recycling in that, which they're going to take advantage of. Then you got a 4 to 5 year harvesting period. You've got a fund life cycle of 8 to 12 years. It's not that hard to envision being in a year or two of harvesting, which is year 7 or 8 of that fund life, and having some LPs raise their hand and saying, guys, it's been 8 years. Can we get some more DPI and liquidity here? So that underlying nature and the fact that the GPs themselves are making 5+ year loans, on average, you're going to have these longer liquidity needs. So that's a key thing to understand just in the fabric of this market. I'd agree of that risk is legit for a subset of deals, but by and large, we are staring at a pipeline full of youthful, performing, seasoned loan portfolios.
Comes down to the underwriting, obviously you and the team do, and those elements as well, just to understand what's being looked at. A last question, competitive pressures. There are more now offerings coming up, and does that also change some of the pricing dynamics as there's more competition to offer these liquidity solutions to a GP or an LP?
Yeah, it's very important in this market, like it is in the direct lending space, to be in that lead, co-lead position in a GP-led CV type process. Scale is incredibly critical in this business. If you are not in that lead share, you become a syndicate player, which is still very attractive from a return perspective, but you're largely just riding the coattails of the lead investor who is dictating structure, dictating terms, potentially getting some sort of fee discount, immediate alpha, right? If you're just in that syndicate player role because you're not big enough to be in a lead role, you're not going to have a ton of success, I think, in this space. So size is pretty critical. That's why you see, I think, some pretty recent success with some very large funds recognizing that, hey, like scale is key to be successful in this business. It's the same thing on the equity secondary side. I think longer term, competition is going to be a reflection of the folks that enter this market. So we would argue today that the vast majority of flow is in large cap DL portfolios. You just see a lot of competition from these large cap DL primary funds who moved over. It's very intuitive for them to go after those kinds of assets, right? They are a bit more competitive. It's pretty hard to go wrong selecting one of those portfolios, whoever it might be from the top 15, 20 operators. But you begin to move either down the risk spectrum into unitranche or second lien or mezz, or move away from the large cap market, you're going to see a little bit of a decreased competitive set. Not huge. These are still good assets that should get priced very fair and appropriately, but the buyer list gets a little bit different once you move away from big brand name GPs and large cap portfolios.
Very helpful. So thanks for a great conversation. Learned a ton. 3 takeaways for me. 1, what is private credit secondaries? And I think you framed it well with the derivative idea. And this is a market that is growing and faster moving just because the underlying instrument of private credit is also fast growing. So those will move in tandem, and that's the interesting opportunity set for investors. Two is where it sits in their portfolio. As you mentioned, it's not a replacement for private credit. It really is a complementary way to play the asset class. So it's a subcomponent of what could be a larger private credit allocation for an investor. And three is what dawned on me is kind of some of the inherent structural protections that are part of this. If you kind of think about whether it's the interest accruals or payment deferrals, but some of the structuring around this as well affords investors some cushion as they think about the opportunity set and maybe already a first loss protection that's embedded in the transaction structure itself. Well, Alex, this has been a terrific conversation. Thanks so much for joining. Learned a lot about what is a really exciting space in the private credit industry.
You bet. Thank you, sir.
Thanks so much for tuning in. Join us next time on Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. Past performance is not a guarantee of future results. Views and opinions expressed may not reflect PGIM's and are subject to change. This is not a solicitation. Copyright 2026 PFI and its related entities registered in many jurisdictions worldwide. Please visit the Terms and Conditions page on www.pgim.com. PFI is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom.